That's great. Thanks a lot, Mario, for that very kind introduction, and thanks to everyone for sticking with us. For those of you who are in the Eastern time zone over your lunch, so hopefully we can provide a bit of entertainment while you're nourishing yourselves midday. Um, as Mario had said, we started out a bit more narrowly focused with the Canada-UK relationship at the beginning of the executive summit, and we're now going to kind of broaden it out and look at the state of the global economy and also what it means for our members and Canadian businesses as a whole. And really, I think what we're hoping to get from this hour is we all see the headlines in the news, whether you read the Globe and Mail or whether you're reading the Financial Post, but we actually want to kind of dig in a little bit behind the headlines and sort of understand what are the real underlying drivers of what's going on in the economy. And so we're really fortunate to have four folks from the sort of the economics world who will be able to speak to this from varying perspectives. We have Peter, who's joining us from Export Development Canada. We have Sadiq from Sun Life Global Investments, Ben from the Canadian Association of Petroleum Producers, and Sahil, who is with CWB Financial Group. As folks will have heard from the first session, we're still going to be using Slido to take audience questions, so I would encourage you to keep submitting those through, and then we'll have a chance to get through them as many as we can towards the latter part of the conversation. So maybe just to start off the panel discussion, maybe Peter, I can go to you first, and perhaps just to provide a bit of a level set, could you say sort of what the performance of the Canadian economy has been over the last 15 months from the start of the pandemic through to today?
Thank you, Mark. It's a real pleasure to join you today. Thank you for the invitation to be here. The Canadian economy has really, like much of the rest of the world, gyrated in the COVID period of time. And really, it could be classed as sort of a K-shaped response to the pandemic. What I mean by that is that some industries actually were very sought after in the immediate aftermath of COVID. Industries like the food industry and building supplies also did very well. And of course, this wasn't just a Canadian thing. This was a global phenomenon. And so our exports were in hot demand in these categories as well. So not only were retailers in our grocery segment and also in the building supplies segment on the top of that K-shaped outcome, but our exports in those industries were highly sought after at that time as well. So whether it was domestic or external, we had that high side of the K. Now the low side of the K is much as it is in the rest of the world. The industries that initially did really badly were things like tourism and anything related to that. So arts and entertainment, accommodation and food, the aerospace sector itself, air carriers were hard hit. And of course, our energy sector as well was very hard hit because nobody was commuting at the time. And of course, the aerospace sector is a huge consumer of fuel, and that went down as well. You remember the period where we had negative prices. So the Canadian economy, being very exposed to the energy sector, saw the extremes of the K-shaped outcome. And really that's where we're, so where are we at now? I mean, that's all history. Well, there are certain parts of the Canadian economy that came roaring back. The consumer, which is 60% of our GDP, had the V of all V-shaped recoveries. And so 2 months down, 2 months back up to pre-pandemic levels of activity. And of course, that was the same in the United States and in Western Europe as well. So our experience was the same as everybody else's, but more radical. We dropped by more and we recovered by more. We were actually better off than these other economies once we got through this period of time. But we, like others, have those industries that are still down in the chasm and are still suffering very much as a result of COVID. And that's why our GDP has not managed to get back up to pre-pandemic levels of activity. So there are those on the high side of the K that are doing very well, that have surpassed pre-COVID levels of GDP. And there are others like arts and entertainment. My son is actually in that industry where it's dropped 50% and it hasn't recovered at all. So half of all activity is still missing inside of a very key industry. So that's sort of what COVID has done to things right now. If I can just inject a little bit of the forecast now, we're saying to everybody, fasten your seatbelts. Herd immunity, which is a combination of the surge of non-lethal infections and vaccinations, is actually building up quite precipitously in key economies, particularly that one south of our border here, and is enervating the economy at the same time as a wave of stimulus is coming in thanks to the Biden administration. So that was our story. Our story now is, okay, how do we actually harness the economy to take advantage of the growth that is coming our way right now and into the second half of this year? I hope I didn't cover too much there, Mark, but that's a tough question to do in just a minute or so.
No, that's fine, Peter. So Sadiq, I'm going to turn to you next. I mean, Peter's on the front line, so to speak, with EDC and helping exporters day in day out. You're looking at it from a bit more of a macro view at from an asset management standpoint. So I mean, Sadiq, what are you sort of seeing as how we performed from again March of last year through to May 2021?
Yeah, I would start off with saying that actually Canada's economy has held up relatively well when you compare it to other parts of the world, especially when you think about that, Canada's had more restrictions in place than our US counterparts. And if you look at the job picture, and I think, Peter was alluding to this earlier, we got back almost 90% of the way there compared to where the US is a lot less than that. And when you think about the economies that are coming back strong, it is definitely the energy sector. If you think through supply and demand there, demand went almost down to nothing at one point last year because we had not only did we have cars off the road, but just generally the economy was at zero at some point in time. And therefore the demand for electricity, for getting buildings up and going, we're not there. Today, we're starting to see a lot of that reverse and the opening starting to occur. At the same time, we're not seeing massive amount of supply coming online at a level that can match up with that demand. So we will see this imbalance for a period of time, which is nice to see because in the past, we haven't seen that. We've seen excess supply and not enough demand, which has hurt our energy sector quite dramatically. So we're finally seeing a boost there, which is definitely great for Canada's economy. Now, when you think about the markets, we definitely had a difficult time last year, as did all other world economies. The US kind of rebounded back a little quicker than Canada did. And that really was because it was putting in a lot more stimulus into the economy. It had a boost from the election a little bit coming through as well. It was also the first economy to start getting the vaccine rolling out. And as we know, it's at a faster pace than Canada, though I might add that Canada is actually starting to do a good job in the more recent weeks to play a little catch up with the US as well. So all of those are boding really well. And of course, our biggest exporter is to the United States, right? So with the US recovering faster, and if you look at New York as a good example, New York's about to open up 100%. And so that's going to be great news for our export business. If the US is strong, that will help us out for sure. We have to be a little bit careful though, like Biden, very similar to Trump, is still going to push the buy US, strategies going forward. So that will probably put us at a little disadvantage. But again, I don't see how they're not going to continue to buy, what we are selling going forward as well. I'll also add that when you think about the rotation, so last year was a story about growth and technology. Think about it this way: that last year's return on the TSX, 70% of that return came from just one stock, Shopify. So if you think of it from that perspective, it was a very narrow market last year. That should change this year, and we're seeing evidence of that. And what's probably going to come back is that value segment. So areas that are tied to things like energy, financials, materials, commodities. And guess what? Canada's made up a lot of that. So this really bodes well for Canada, after many years of probably being behind the scenes of the other markets. So I think this is a pretty good environment for Canada coming out of this. And because it's held up well from an economic standpoint, I think it'll be one of those economies that will look really strong when you look at the end of the year.
All right. Well, thanks a lot for that, Sadiq. And maybe we'll get in the chat box because you mentioned the TSX. People will be asking you for stock tips, but we'll try not to send too many of those your way. So Sahil, maybe you can bring you in now to talk a bit about the forward-looking piece. I mean, things have been going quite well, but some people are talking about the prospects of inflation. The red hot housing market seems to be across the country. You read the stories about these insane bidding wars that people are going through in houses selling for way over asking. So I'd just be curious. I mean, you're out in a different part of the country than Peter and Sadiq. So how is it looking, from where you're sitting about the outlook for the economy going ahead?
Okay, thanks, Mark. Let's go back to March 2020. Let me give you a little bit background about what happened in the macroeconomy, because I don't think we did that well. It seems so, but there's a backstory there. So in 2020, the budget deficit of Canada was $350 billion. And at the same time, if you look at the money supply, it was around $350 billion. There are a lot of details here and there, but simply what happened in 2020, Bank of Canada said that I'm going to print a bunch of money out of thin air to increase money supply. I'm buying government bond, here is some cash. And we spent that cash and we think that, oh, it seems that everything was okay, we did well. But the question is, what is going to happen because of the $350 billion? And this year, the estimate is $110 billion. So we are spending like, you cannot find any time in the history that we have spent so much money. So going forward, we have that kind of money printed, and here it comes the hard part. If you take that money out of the economy because someone has to pay that money, or government cannot sustain with $100 billion deficit, what is going to happen to the economy? Can we have a strong demand side or not? That's a big question for the economy. And then another risk because of that spending that we had to solve that problem would be when you're printing money, the interest rate will go up eventually. And that's going to be a problem for the Canadian economy because we know that our debt to GDP ratio is very high. So overall, when I'm looking at the picture, what happened in 2020, what is going to happen, 2021 and next is we had very, very generous fiscal and monetary policy, and we know why, because of the global pandemic. And that could create some problems. So I don't think that we can say that we are okay now. We have passed the pandemic. Here's the reality. We have spent so much money and inflation is going to be there, higher interest rate, and that is going to create some problems for the economy.
Thanks for that, Sahil. So Ben, Peter had talked a little bit about the oil price shocks that we had seen at the start of the pandemic, and certainly for your industry, it wasn't just necessarily a pandemic challenge, but you were having issues even before the start of COVID. So again, how was that kind of perspective looking from the oil and gas sector?
Thanks, Mark. Yeah, some great comments here from my colleagues. From our perspective, 2020 was an exceptionally difficult year for our industry. There were effectively two shocks that hit our sector. The first was the OPEC plus production decisions that had some substantial impacts with respect to sort of pricing and corresponding economics and investment for our industry. But the layering in over and above that, the COVID crisis that sort of created the demand shock really sort of placed our sector in a very significant situation. Effectively, we had a liquidity crisis for our industry last year. We saw negative pricing, which we'd never seen before. And we'd seen our industry respond accordingly. So capital budgets were slashed about 30%. We saw about 120,000 jobs lost in our industry. And we shut in production to the tune of 700 to 800,000 barrels per day. So those factors really did put us in a difficult position. As we sort of weathered that, we are seeing some positive signals, and we think that we have turned a pretty substantial corner sort of looking ahead into 2021. So say Q1 last year, the balance sheets collectively of our industry, negative, say, $5 billion in losses. Now we're looking at the Q1 numbers coming back to the positive somewhere around so $3 billion or so far, some of the majors that have been announced. So stark contrast. We're seeing the demand come back, which is favorable. The economies are starting to reopen, notably in the United States, but in other areas as well. And so that's creating some better demand for our products. And we're seeing that from an investment perspective. So this year, from our forecast perspective, we're anticipating a 14% CapEx increase for our industry year over year. Now, that doesn't get us out of the substantial deficit of capital spending, relative to what happened in 2020, but it does demonstrate that we've turned a corner. And looking ahead, there are some favorable signs with respect to the future of our industry, but we're going to be spending a fair amount of time sort of getting out of the pandemic and repairing our balance sheet for the foreseeable future. So definitely not is sort of into those sort of favorable circumstances from an investment perspective, but I'd say that there's some cautious optimism in the sector looking ahead.
So, Ben, one of the things I'd be curious to know, we've been seeing pipelines have been in the news and energy infrastructure over the last little while, whether that is the inability to build, the inability to operate, or on the cyber risk side, as we've seen over the last few days. From the perspective of the industry, are these things just sort of white noise blips, or are these real kind of, if I can use the phrase, bend the curve moments for your sector?
It depends on what you're talking about specifically, I suppose. We've been challenged without a doubt on pipeline infrastructure for our industry. So certainly the Keystone XL decision was not a favorable one. That was quite unfortunate from our perspective. But there are other pipelines sort of that are afoot, such as Line 3, the expansion, TMX, et cetera. So, those are in progress, and those will be quite important for our industry. But then we're looking at the risk to existing infrastructure. So I think you're probably referring to the Continental Pipeline outage that we're seeing right now in the United States. And what that is an illustration of is the energy security and the reliance that we have on oil and gas infrastructure, and the risk that sort of from a disruption perspective that can come to bear as a result of these unforeseen circumstances. And then we are seeing the Line 5 discussion play out right now. And those factors are disruptive. We view them as sort of temporary blips, if you sort of want to call them that at this point in time, in the sense that they're unanticipated. They have risk inherent in them, but from a long-term perspective, we would expect that those types of pipes would continue to be reliable, and they would continue to be delivering energy products, consistently to the client base. I would say what they do illustrate is the importance of our industry in the current economy. And, looking down the road or forward, any credible third-party forecast that we see, whether notably the IEA or others, suggest and indicate that there will be increase in demand for oil and gas as the global economy recovers for the foreseeable future, which is illustrative of just how important our products are. Naturally, we're going to be looking at, how can we strengthen our ESG performance on our industry, and ideally positioning the Canadian oil and gas industry as the barrel of choice to meet future oil and gas demand. But make no mistake, there will be growth in future oil and gas demand, and we should be positioning our industry and our product as that barrel that will meet that demand.
Well, I see we did get a question actually coincidentally in about ESG, so we'll come back to that one I think a little later on in the conversation. So Peter, if I can go back to you, Sahil talked a little bit about interest rate hikes and inflation. Where you're sitting from the vantage point of an entity that deals with exporters, what do you sort of see as the cascading effect on exchange rates, and what does that mean for the folks that are in the international trade space?
Well, if Sahil is right, and we have this downdraft that's coming out of the economy, then the date when interest rates would go up would be put off for quite some time. And many were thinking not so long ago that time would be somewhere in the middle of 2023. If we had a serious downdraft after the end of stimulus, both monetary and fiscal, that could get kicked out even further. I guess I challenge that view because at the same time as we would see downdraft in stimulus, we've got Canadians who have thrown into their demand deposit accounts at the moment something like $230 billion, and that's just sitting there as liquidity. Now, half of that, roughly speaking, is consumer money, half of that is business money. So this is an extraordinary development of ready cash above what would have accumulated under normal trend conditions. And we see the same thing in the United States. In fact, they've got more than 15% worth of GDP in those demand deposit accounts, and Europeans have done something roughly the same. Now, where does this money come from? Well, if you're getting a stimulus check and you don't know when you're going to get called back to work, if you're out of work, and if you're a business owner and you don't know when the lights are going to go back on, well, you're not going to go out there and rashly spend that stimulus check. You're going to hold on to as much of that as you possibly can. So arguably part of this could be stimulus money that people are putting aside. We don't know, but think about all that vast majority of people, and I mean no discredit to those who have lost their jobs, but the vast majority of people actually kept their jobs, drew a full-time paycheck, and had far less to spend on. You know, people weren't going to concerts. They were not going to restaurant meals as much as they were doing before. They weren't going to sports games. They weren't going on high-priced vacations. Most of us weren't doing the commuting we were doing before. And, you know, some of these were extraordinary, but some of them were actually ongoing expenditures, and we simply weren't making those. And so what do you do with that extra cash? Well, that's what seems to have built up inside of bank accounts. And so as stimulus draws off, this money can very rapidly roll into the economy and will be tied us if it all comes in one giant tsunami of spending, because then, you know, to your point, we might have significant inflationary pressures inside of the economy. So cognizant of that and the pressures that are already building up as the economy is coming back, you know, it's easy to shut an economy down. It's painful, but it's easy. But, you know, getting it back going again is problematic for quite a number of reasons that time doesn't permit us to get into here. But we're already seeing inflationary pressures. The Bank of Canada came out in its monetary policy report and said, yes, they're significantly above the midpoint of that target range, and they're going to be above the midpoint of the target range at the end of 2022, which was a really unusual admission to make. So they said two things. First of all, we're going to start tapering, and we're the first one in the G7 to do that. Second of all, very significant message that they put forward is we're going to bring nearer the first point of what we think is going to be the beginning of interest rate increases. And so anywhere from 6 months to a year in advance of what was thought before. And so we are not loosening, we are not of the mentality that there's going to be this big downdraft. We're arming ourselves for an updraft in activity. And one last thing that I'll put onto that is that additional 1% of GDP growth that the OECD says Canada is going to get by virtue of the Biden stimulus program.
Okay, thanks for that, Peter. So we're going to go to Sadiq, and then we'll go to Sahil afterwards. So Sadiq, why don't you sort of share some thoughts on what it looks like from your standpoint?
Yeah, I mean, so Hill's right that we have a lot of debt for sure coming through, but the whole world has got that debt coming through as well. And it was a situation, right, where we had to, you know, save the economy today. Otherwise, there would be no economy in the future. And so you have to invest in the economy, invest in people and corporations. And that obviously has caused a lot of debt. Now, how that gets played out in the future will be very important. But again, because every economy around the world is in a similar boat, I think this is going to be a lot more gradual payback of that debt over time. And interest rates still will go up. You know, we're sure of that, obviously. You know, how it moves up will be very important. And I don't think we're going to see rates, at least in the United States, go up until about 2023. Canada might jump ahead of that, I think, because it's again holding up better than what the US has at the moment. But, you know, I go back to that comment, you know, when you look at Canadian consumer debt to income ratio is much better now than it was a couple of years ago. The housing market has held up relatively well, which means their net worth of individuals are doing extraordinarily well. You know, I think Peter alluded to the fact that savings rates are enormous, not only in Canada, but US and international markets, which means there's pent-up demand to spend down the road, which will again boost the economy, which will create more jobs, and again will help this economy continue to go in the right direction going forward. And I don't see any sign of that slowing down. I don't think governments are going to want to do anything to slow that down in the immediate future. And that means to me in the next 6 to 12 months, because otherwise everything they've done so far to stimulate the economy goes backwards, and they don't want that to happen, right? So they rather let the economy go overheat before they decide to do anything about it. And that brings us to inflation. So we saw today the US inflation number come out. The market did not like it at all. We saw a big sell-off coming through, particularly in the high growth names that have high valuations. And so you've heard that from the US and from Canada that inflation is going to be allowed to run hot. They've used the term transitory. Now, again, no one's defined how long transitory means, but I think inflation is going to be here for a lot longer than people expect. And that means, again, that the economy is going to remain hot, that the governments are going to stay on the sidelines for a lot longer than people expect. But the market may not still believe that. And that's the important thing to remember, that the market can potentially cause the Fed or the Bank of Canada do things that they don't normally want to do, but because of what the market reactions are going to be, could cause them to step in and do something along the way. So I think that, yes, debt is an issue, but I don't think it's an immediate issue for anybody at the moment. Consumers are in much better shape. I think coming out of this, we have to remember that a lot of these corporations have done a lot to improve their balance sheets, either refinancing their debt, they become more efficient. So coming out of it, they're going to be much stronger than they were going into it. And that again helps it, throughout, down the road when rates do eventually start to go up.
So I guess, Steve, maybe just to pick up on that point about the market expectations and what's built in. If someone were to say that we're sleepwalking into a sovereign debt crisis, because we've seen some of that commentary, do the markets say we're sleepwalking into this in your view, or is it kind of baked in, or do we not think there's going to be a sovereign debt crisis at all, given everyone is in this boat around the world?
Yeah, I would say we're going to be in a sovereign debt crisis. We're definitely going to have excessive debt coming through. I think the market knows that. The market just doesn't think we're going to act on that debt for a few more years. So that's what it's being, and the Goldilocks scenario that, we're going to continue to get these stimulus checks. The markets are going to continue to go higher, and housing markets are going to continue to do well, and everything's going to be great. But eventually, as Soel mentioned, we will have to pay that down. But the market is not looking 2 years out, it's looking 6 months out. And 6 months out, it doesn't see rates going up, it doesn't see the debt problem coming through, and it looks at its balance sheet and says, you know what, I got a healthy savings rate here going on, and the economy is about to open up, and I'm looking forward to go on my vacation and spend that money and enjoy my life again, unlike what I was doing over the last 6 to 12 months.
Yeah. And an interesting stat about consumer confidence, just one sort of piece of anecdotal evidence more, this, I was speaking to our Australian colleagues earlier today, and they were saying that even for them, where they've had a very low case count all throughout, they're still in an environment where only about 40% or so of the office wants to go in the white collar workforce. And so I think that speaks to, if that's what it's been like here, you can imagine how much harder it's going to be to get the reboot, going here for consumers spending that money, potentially. But maybe, Cecile, we'll turn over to you and sort of bring you into the conversation on this point.
Me?
Yeah.
Okay, sorry. Yeah, so I was not suggesting that the economy is going to slow down because the government is cutting the spending. But think about that structure. We have spent so much money. We had loose monetary and fiscal policies. And today in US, the inflation was 4.2%, higher than the estimates. And now we know that there's a lot of saving in the economy. And imagine that if that saving converts to the spending, now you have another demand shock for the inflation. That is the part that I'm worried that the consequence of that spending that we have is the environment is not ready to have that boost from the demand side. If we have that boost, then we are going to be very concerned about inflation and interest rate. So that is the kind of puzzle that unfortunately the central banks now they face. They don't want to hike the interest rate. They know that the economy is not ready, but they know that if this consumption comes from that massive saving, then we will have another pressure on the inflation. So inflation, again, could go higher. So then we need to ask this question. If you're assuming that the consumption is coming from the saving from the consumers, then it means more pressure on inflation, more pressure on interest rate hike. How much the economy is ready for that interest rate hike? Housing market, we had 30% year-over-year growth because of, again, loose lending policies because we wanted to get out of this pandemic. So if you hike the interest rate, is housing market ready? And we know that what will happen then. So overall, what I'm saying is because of the policies that we had, monetary pushing the interest rate to all-time low, after the pandemic, we are going to be challenged by inflation and interest rate. And I know that the saving, the consumer is going to help the economy, but kind of that loop that we have that if they spend more, there would be more pressure on inflation and more pressure on the interest rate to go higher.
Thanks, Sahil. Ben, maybe if I could turn over to you from a bit more of a commodity sector specific perspective. I mean, once people start driving again and flying again, presumably the demand for oil is going to go up. So what are your forecasts telling you about the path ahead for oil prices and what that means for Canadian producers?
Thanks, Mark. Just as a trade association, just from a caveat perspective, we don't ourselves predict price. We sort of steer clear of sort of that side of things, but we do sort of follow sort of the forward curve and what it means from an investment and production perspective. So in terms of sort of looking at what the outlook is from commodities for oil and gas, we observed that there's some good strength and some consensus strength in the outlook for oil prices, near term and long. So what we're seeing now, some very good prices that have led to some very good results for our member companies. And our expectation is we're going to see some consistency. Looking ahead, naturally, there's some volatility, et cetera, but sort of medium to long term, these prices that we're seeing, sort of we expect to sort of remain and actually improve based on sort of what sort of we look at from a survey perspective of third parties in terms of the pricing. What that means for our industry is generally it's good news. So from the oil side, demand in North America for the heavies is going to remain strong, and particularly when we're seeing production decline from traditional sources in the U.S., so Mexico and Venezuela, forecasted to decline, and that's going to create some strength for Canadian oil sands in the United States. And so that outlook actually looks quite good. From a gas perspective, our expectation of what we see in North America is good demand and expected sort of strong demand for electricity, LNG exports, et cetera. And our companies in Canada have undertaken substantive efforts to reduce their costs and strengthen their balance sheets, and they're well positioned to take advantage of that. So both oil and gas actually near term look pretty favorable for our industry, which is great. But in terms of what the companies are doing, we're still in a position of strengthening their balance sheets and sort of and their financial position. And so no one is going to be undertaking, or not no one, that's a pretty strong statement, but generally speaking, companies are going to be looking to pay down their debt. If they're going to grow, it's happening through an M&A level of effort. So I think we've seen some very substantial M&A activity occur in 2021. I think that's a reflection of some confidence in the future. And then also just looking at what the cost looks like. Growth through acquisition really makes a lot of sense for a lot of these companies. And then any incremental investment, because we do actually think that there's probably potentially some upside, would come through additional cash flow through the company. So there won't necessarily be sort of significant borrowing, et cetera. But we do think that when companies are starting to get into that positive cash flow side of things, they will see some incremental investment there, notably on the conventional side. So generally speaking, we think that right now companies are seeing some confidence. They're well positioned in terms of getting their costs down and positioning to take advantage of sort of market opportunities that are looking relatively favorable. And provided that we see decent developments in terms of sort of these pipeline expansions and some strength in the markets over the next few years, that's where we could start to see longer term confidence in the sector. But right now it's really difficult to sort of indicate what the market looks like sort of 2 to 3 years out, just given the uncertainty with COVID and a number of other files that are out there.
Okay, thanks for that, Ben. So Peter, maybe if I can go back to you, just to think about a comment that you had made around the sort of varying vaccine rollout rates around the world. And certainly, what we've seen is that emerging markets are definitely lagging behind industrialized markets with that vaccine rollout. So given there is such a stark differential, especially in markets that are key trading partners for Canada, minus the United States, what do you think is the impact going to be on Canadian companies because of the varying paces of vaccination?
Well, given that we, depend on international trade for a substantial portion of our GDP, as we all know, add imports and exports together, our trade intensity number is somewhere around 64%. We are, very exposed to the United States market. That's, as we know, where 75% of all of that trade actually occurs. we're also, to a lesser degree exposed to our traditional markets in Western Europe. That might add another 5 to 10% to that overall. And so you're looking at the preponderance of our trade being in nations where vaccine rollout is actually happening apace. Now, we've got a globalized world. So, just because we're operating in a country that might be getting out the other end of this doesn't mean that they're not exposed to that, because they're very globalized economies as well. So really, this is a global thing. And the efforts really to make sure that we have vaccine distribution that is reaching right around the globe at an appropriate pace is in all of our best interests. So again, the combination of that non-lethal infection and the vaccine rollout really is what gets us to, the Ontario government's definition of herd immunity, which I don't think really is different from anybody else's definition of the same. And that's when we get to the point where, okay, we can resume this trade as much as possible. Now, trade flows have come back in a similar V-shaped recovery to what I illustrated inside of retailing. It wasn't quite as closed a V. It's taken a while to get right back to those 100% of pre-COVID levels of activity in Canada's export picture here. And we're not much different from most other places in the rest of the world, with the exception of China. China got back incredibly quickly because of its governance and because of the direct impact that government dictums had on what people were doing. But they're really out of step with everybody else, and we're coming back. But I would still say that we've all experienced those V-shaped recoveries. Now, what does that mean for us? Well, goods and services can flow. Our initial fears about, landing a ship at a point where, all of the hands on the ship, I guess, would be possibly exposed to COVID. Those days are long behind us. All the precautions have been taken, and those global trade flows are actually occurring quite appreciably. What business is telling us at EDC that they're really concerned about is the lack of ability to do person to person. So as Ben has said, there's a wave of investment coming our way. I would say that transcends oil and gas into many other areas, not just of commodities, but of regular business. As we get back up and running, there's been this technological realization, a productivity boost, if you like, that has revolutionized not only retail, which has had to really transform from a bricks and mortar kind of setup to being much more digital. They've had to do that overnight. That's a pass or fail kind of thing that they have to do. Well, the same thing is happening right across industry. So as that occurs, one needs to be able to have person-to-person interactions increasingly. And Canadian businesses are telegraphing back to us that one of the greatest, in fact, the number 2 concern that they registered with us was the inability to have person-to-person transactions. If you're trying to line up financing, if you're trying to do a merger or an acquisition or a greenfield investment somewhere, if you've got a brand new, large, lucrative contract in an unfamiliar country, you're going to need person to person to build those relationships and to be able to have trust on either side of the table. We need to see them, they need to see us. You need to hang out with them for a bit before the comfort level is there. Some people are doing that digitally, but many others are saying we're not going to be able to do this until then. If you're doing a big investment and you need technical help to come in, again, the person to person is an encumbrance. So that's a big logjam inside of being able to move forward at this point. And if we can get over it digitally, that'd be great. But to date, the inability to do that really is something that is going to exacerbate that logjam that we feel inside of the economy at this point in time.
Yeah. No, and absolutely. I mean, the whole point about having people-to-people contact to press the flesh, as it were, is absolutely critical, especially when you don't have pre-existing relationships. And definitely that's been a theme that we've heard all throughout from our members since day one of the pandemic. So Sadiq, I want to actually start to go to the audience Q&A and bring you in. There's a question here around ESG considerations and whether we're talking about the TCFD, the Equator Principles. I mean, there's a whole sort of constellation of things that are out there. From someone who's in an asset management business, what's your sort of take on how ESG has impacted investment in the Canadian economy? Has Canada been able to, pivot and to tell a good story? Do you think other companies have perhaps been unfairly penalized, if I can phrase it in those terms, around sort of how ESG has been used and deployed in the financial sector?
Yeah, that's a great question. I mean, I can start off with, our own company, Sun Life, has, very big sustainable goals. And I think it's not only, our company, but the broader industries as a whole are all moving in that direction. ESG has been a big theme. And for people who don't know what ESG, it's environmental, social, and governance issues out there. And it really is something that is not only important for corporations, but you've seen individuals who own corporations vote with their shares to improve companies, to make sure they're doing the right thing for the economy, for individuals out there. That ties in things like diversity and inclusion, so many other things that get thrown into that category. And I think Canada was a good first leader in this area. International markets are another area that are big leaders as well too. And I think Canada's always been known as a social country. And that's a great thing because it's doing all the right things. The one headache that it might have is just the energy sector. And I think sometimes it gets caught up in a bit of a bad brush here sometimes. But I do think there's a lot of good things going on in that sector as well that are starting to improve and getting forward. And I don't know if Ben could add more to that as well. But generally, I think that Canada's companies and corporations are all moving in the right direction when it comes to the ESG front. It's a big theme that's coming through. They've invested a lot of money and effort into getting the things done right. They do care about the people and they do care about the world. And so you've heard a lot of companies say that, yes, profits are an important part of what we do, but doing the right thing is just as important as well. And, you can give up a bit of profits to do the right thing going forward. So I think, yes, the short answer to that question is yes, companies in Canada are doing the right things. There are a couple of areas like the energy sector getting hit a little bit harder than others when it comes to that, but I think they're moving in the right direction.
Well, I mean, Ben, your members are on the front lines of this day in, day out. So, I mean, how is it looking from your association standpoint on ESG issues?
Yeah, thanks. No, ESG is very topical for us. It's a top priority for our members, without a doubt. In terms of how we look at it, and I think Sadiq covered it from an overview perspective well, clearly, emissions intensity is the number one issue that sort of we focus on from an ESG perspective. It's right now we would say that's kind of shorthand for ESG, but we also recognize there are some other elements that sort of are top priorities that are emerging in terms of the level of attention they get. So Indigenous engagement, diversity and inclusion, air, land, and water performance, and pipeline and process safety. So all of those combined really round out sort of our focus of priorities on ESG. But from an emissions intensity perspective, what I would say is our industry in Canada has some of the most robust data and disclosure and environmental regulation. And as a result of that, we can demonstrate and showcase the depth of the work that we undertake on climate emissions intensity. But unfortunately, what that also does is it doesn't create the level playing field from a comparability perspective. And so the depth of what we undertake and the performance we showcase, I think, tells a really good story. And in fact, we could look at natural gas and liquids, we could look at in situ production and oil sands mining, and we can demonstrate that substantial improvements have been made from an emissions intensity performance perspective across all three of those sectors. And, in fact, and what's not sort of as well known is, our performance in these areas are as good as we see in comparable blends in North America, for example. But what isn't told in this story is internationally, we'll see comparisons, but the data just aren't as deep. And so they might emit, for example, methane emissions, or they might not necessarily have the same sort of definition of scope. And as a result of data inconsistency, we could be positioned less favorably relative to some of these other jurisdictions. And unless we're out there defending each and every conversation, the easy conclusion to draw is, Canada's performance isn't what it needs to be. But unfortunately, that's actually only part of the story. And so what we're seeking to do is, evaluate and look at, the quality of the comparables and encouraging governments, Canada, Alberta, all the provinces, to develop consistency and comparability in the data, so that and to advocate and to demonstrate that with their colleagues internationally. So when we see European countries wanting to negotiate with Canada on, say, carbon border adjustment agreements, or we're talking with international investors about sort of investing in Canadian oil and gas, that conversation's at the fore to sort of demonstrate the actual performance and demonstrate the comparability so that folks can understand exactly what it is we do, and compare it to what we're seeing these other jurisdictions do, because we think we're proud of our story, and we think that we actually have a good one to tell.
Well, and even too, when you talk about what our jurisdiction's doing about, say, things like carbon pricing, how does that factor into carbon border adjustments? I mean, one of the conversations that we've been having internationally with our colleagues is there really is no one sort of single carbon price in Canada, because it is being done on a provincial basis. And so how do you calculate even what the sort of carbon price is of a Canadian product going into the EU? I mean, there's just a whole host of landmines that are in there. I mean, has your association done any work to really kind of dig into the carbon border adjustment issue?
Yeah, I mean, we certainly have. I mean, it's early days, and we've reached out to government to understand sort of the scope and the focus that they're undertaking. This is particularly important, particularly with the United States and their ambitions. So as we talk to government and as we look at the issues, one of the things that becomes clear is there's not full awareness of exactly sort of the ambition and the stringency that Canada has in place. So certainly in terms of the effective carbon price, that's one thing. But even all of the elements that sort of come into play in Canada's climate ambition and policies, it's not necessarily assumed that these other jurisdictions are aware of those and would recognize them. And that's actually very important to do, because if we're looking at a carbon border adjustment negotiation with any country, it's effectively an equivalency discussion sort of for trade negotiation. And there needs to be that clarity about just how significant it is that Canada has undertaken these programs, and the equivalency needs to be reflected back into those conversations, those bilateral negotiations with the governments. And so we think that there's incremental work that needs to be done there, but that's the starting point. And what's been sort of a bit of a surprise to us is it's not taken as a given that folks are aware of what Canada has done. And so part of that is an education process with some of these international jurisdictions. We think that's part of the key to really getting the recognition for the efforts that we've undertaken thus far.
So Sahil, I'd like to turn to you. There was a question that's come in about reining in consumer debt without causing damage to the economy, and you talked a little bit about sort of consumer spending habits. And so maybe if I could put the question to you, do we have sort of a risk of runaway consumer debt once the economy starts to reopen, kind of picking up on your earlier comments? I mean, is there a way that we can look to rein this in to have people, if I can call it, spend in a sustainable and manageable way?
So there's always a kind of bad news in the economy and good news, right? I told about the bad news, but let's look at the good news a little bit. So Canadian dollar is a commodity-based currency. And if that inflation story holds, it means that there would be more revenue for the Canadian economy, simply because we're exporting a lot of commodities. So yes, the risk is there, inflation and then rate hike. But if you assume that that story holds, it means that more kind of income revenue for the Canadian businesses. So we should always remember that if that inflation story holds, that means higher commodity prices. And you can see the commodity prices, lumber, copper, canola, everything, recently iron ore. So that is going to help Canadian economy a lot. And another thing is, we might have inflation over 3%, which is the max inflation that Bank of Canada says that I can tolerate up to 3%. But I think this time they're going to hold off interest rate hike a little bit because they don't want to hike the interest rate when the economy is not ready. So they want some of that demand to work in the economy to help the small, medium-sized businesses. And even if you have inflation, even if you have like more than 3% for couple of quarters or a year, Bank of Canada might say that, okay, I'm going to hold off to hike the interest rate. I can tolerate a little bit higher inflation rate because I want to help the economy. So having the inflation expectation, it doesn't mean that tomorrow we are going to see interest rate hike. And at the same time, it means that commodity prices are higher, that is going to help the Canadian economy.
Great. I saw, Sadiq, you had your hand up. Do you want to come in on this question as well?
Yeah, I think on consumer debt, I mean, it was definitely an issue heading into COVID. We had a lot of debt going on. Part of that was tied to people, overextending on housing. And with rates low, you can see that being, understandable. What people were doing is they felt that the housing market was always going up and rates were going low. So, it was an easy borrowing way to make money on the housing market. But I think as we come out of COVID and we start to see rates eventually start to go up, we will start to see pressure on consumer debt. We'll start to see pressure on housing as well. And that will have, problems down the road. Again, short term, a lot of savings, so that will be okay. But as we play it out, we will see more pressure on the consumer going forward. And again, that will impact net worth, that will impact the housing market, that will impact GDP. And again, that will cause, job losses again down the road. But not immediately as well. So I think this is not an issue that's gone away. It's just been temporarily, put on the sidelines because of what's going on today in the markets.
Okay. So in the few minutes that we have left, I'd like to maybe just ask everyone to, get their crystal balls out. And, Peter, black swan events by their nature are not predictable. But if you were to sort of, look ahead and think about, what would be some, maybe if I can call it, maybe if it's not unforeseen because we're going to try to foresee it, but perhaps an underpriced risk event that could happen in the next 12 months. Where do you think that could, emanate, and what would that mean for Canadian businesses?
Well, we have a top 10 list, I guess, of risks that we think could affect things. I'm going to pick a few of those. Really, these aren't black swans because, as you said, they're things that happen to us that we never saw coming. And so COVID is a classic example of that. Although, some had talked about pandemics in the future and, how their presence was going to be increased over time, not decreased. So what are some of those things? Well, I think Sahil has mentioned some of the easier targets here. How do you unwind ultra loose monetary policy without causing disruption? Does inflation actually rear its ugly head in a way that ties the hands of central banks as they go forward? So even though you might have a debt situation in a country, and we've got sovereign debt situations in all countries right now as a result of COVID era fiscal stimulus, how do you actually navigate through that when, according to your own rules, you should be tightening because of what inflation is doing to the economy? So I would bucket that together into a large area that we're calling loss of policy control. If really fiscal policy is extended to the point where you don't really have control over it because the interest payments on the public debt are so substantial, and you have loss of monetary policy control because you simply have to act in a particular way because of inflation or some other development inside of the economy. Well, it sort of takes its own line. There are others that I could talk about. We're always concerned about cyber threats, and we can see in the oil and gas sector, there's a cyber threat going on right now, but no sector is really immune to that as we become more and more technologized. As we see China saber rattling across the straits and flying into Taiwan's designated zones, there's the worry about that and what it would do to further sort of upset Sino, fill in the blank relations right across the world, and so is there going to be some kind of reaction that sort of creates a bipolar world, as it were, where there's an orbit over here and there's an orbit over there and there's an alignment exercise that goes on? What would a globalized world look like with that? So that's just a sample of some of the things that we're thinking about. Ask a dismal scientist about dismal stuff, and we'll give you lots of stuff on the table that we obsess about. And certainly all companies that have risk plans are testing those, and particularly financial companies were required under IFRS 9 to do that. So I'm sure that all of us around the table are sort of enervated by the need to do this and need to keep our eyes on these things. So those are some of the things that we're looking at.
Okay. So Ben, over to you. I mean, your industry, as we talked about throughout the hour, has been dealing with sort of one shock after another, it seems, over the years. So, I mean, what do you sort of see as a potential shock on the road ahead?
Yeah, it's a good question. I mean, there's all kinds of sort of unanticipated consequences, of course, and geopolitical risk that's in our industry. You know, the one that, you know, I will raise at this point is in relation to underinvestment in the oil and gas industry. So since COVID, we've seen, you know, some sort of stabilization in the capital budgets and whatnot, but, you know, generally speaking, we're looking at sort of you know, capital investment in oil and gas down about 25% relative to where it was in 2019. And you know, 20 to 25 you know, 2020 to 25 sort of forecast and capex guidance for sort of global companies, you know, it's pulled out about 200 billion or so of investment. And so not only are we looking at underinvestment this year, but, you know, forecasting with companies running lean and pulling their investment out, there is a risk that there is some underinvestment in oil and gas production that will sort of, you know, come on stream, you know, as demand recovers. And so we could see sort of the oil and gas industry all of a sudden in a place where prices are, you know, substantially higher, which would create, you know, risk from an inflation perspective, or create risk from a cost perspective, and it could put us in a supply crunch, you know, down the road as demand recovers. And so that's a pretty substantial risk that we're looking at. But of course, we see other geopolitical risk as well, you know, with other producing nations and, you know, Middle East and whatnot. So those pieces are also in play, but sort of we look at this and we think, well, we might not be in a spot where we can sort of meet the demand that resurges in the next couple of years, and that actually would sort of be quite detrimental, I think, long term for our recovery.
Okay. So Sadiq, we'll give the final word to you to sort of give us your prediction for a unpredictable disruption on the road ahead.
Yeah, I would say, you know, when you think about rising yields, those are priced in. People are worried about that. Same with inflation. I think people are not giving enough credit to the fact that this virus is not going to go away completely. I think they assume that, you know, this, by the time we get to about the summer or maybe even the fall, we're pretty much going to have this behind us. And I don't know if that's completely true. I think we don't realize yet that the Moderna and the Pfizer vaccines, we haven't seen it play out for a longer period of time. We don't know what the side effects might be or how long that immunity will last. We don't know how well it's going to react to the variants that we're seeing out there. I don't think all that's priced in. And we could continue to see this going on for years, actually, going forward. Now, it may not be obviously the same levels we've seen during the past year, but there are other variants that continue to be formed. You know, with India in a terrible situation today, there are variants starting to form there as well, too. So, you know, when we open up our borders, we can't guarantee that we're not going to see new variants pop in and how we're going to handle that. So that, to me, is one of the biggest things that are out there. I think the second part about it is, you know, we forgot about global trade again, right? Yeah, it was a big issue the last few years. We kind of forgot about it because we're dealing with a pandemic. But when some of this starts to get, you know, a little bit more closer to home again, and we have the opening of the economy, you know, I do think we're going to start to see some tensions build up there again. And again, you're going to have the two biggest, you know, countries out there, U.S. and China, kind of going at it again. And we did see some evidence of that, you know, last year, but not big enough. And I think you will start to see some of that play out. And that will also have some impacts, you know, on the global economy as well.
Well, and to your point about COVID-19 switching from, you know, if I can say the pandemic phase to the endemic phase, there's one of my friends in the United States, and they actually were participating in a trial for one of the vaccines, and this was last summer, and they're actually now already being talked to about booster shots. So, you know, here we're talking about first and second doses, but in the U.S., you know, boosters and what lies on the road ahead there. So let me just say, because we're at the top of the hour, I want to thank Sahil, Peter, Ben, and Sadiq for giving us their time and sharing their insights with us. I think this was a great discussion to help, you know, get us through the lunch hour and provide some, you know, food for thought for a lot of our members going forward.